Accounting for Business Decisions A Screencast Assignment 2018 by Amy Holliday, 13203967. Today I will be discussing analysing accounts. So, what exactly is an accounts receivable? Well, accounts receivable is money owed to a company by its debtors. In simpler terms, this means it is money that a company expects to collect from a service or sale that they have provided to a customer. After the company has finished recording and reporting accounts receivables and have estimated the bad debt expenses that they may have, they move on to analysing accounts receivables in order to determine how well the business collects its receivables. The first step in this process is conducting a horizontal and vertical analysis. A horizontal analysis is used to measure the business's account balances over time and is conducted in two stages. Firstly, in order to determine the dollar change in a company's balance, you must first deduct the prior year balance from the current year balance. Then, to yield a percentage change, you divide this dollar change amount first calculated by the prior year balance. On the other hand, a vertical analysis is used to measure a company's account balances within 1 year. There are two different formulas used, one for the balance sheet and one for the income statement. For the balance sheet, you divide the account balance by total assets, and for the income statement, you divide the account balance by net sales or revenue. Next, a company can use the accounts receivable turnover ratio to analyse their credit sales during a specific period to the average amount of receivables that they have collected. This is conducted by dividing the business's credit sales by their average receivables. Companies mostly want this amount to be quite high because this means that they have been able to collect their receivables quickly. After this ratio is calculated, companies can use the days in receivables ratio to calculate, in days, how often they collect their receivables. This is done by dividing 365 days by the receivables turnover ratio, which was previously discussed. Additionally, a company can also use the allowance ratio to measure the amount of receivables that they predict to be uncollectible in the future. This is calculated by dividing allowance for doubtful debts by gross receivables, whereby gross receivables is net accounts receivable plus allowance for doubtful debts. So, to summarise, analysing accounts receivables is a crucial step in accounting financial information because it shows potential investors the business's ability to collect their receivables, which can impact a business's overall assets and profitability. So, the various methods that encompass analysing accounts receivables include a horizontal and vertical analysis, receivables turnover ratio, days in receivables turnover ratio, and the allowance ratio. And that is how you analyse accounts receivables.